Hey everyone! Welcome back to Canada Accounting Insights. I'm so glad you're here. Today, we're diving into two really important topics that often trip people up: bill and hold arrangements, and principal versus agent considerations in revenue recognition. Before we jump into the technical side, do me a quick favor: hit that like button, subscribe to the channel, and ring that little bell so you don't miss future videos. Your support helps me keep creating clear and practical explanations just like this one. All right, let's get into it. Imagine a company that sells equipment to a customer, but the customer asks the company to hold on to the goods and deliver them later. The customer still wants ownership now, but the delivery is delayed. That's essentially a bill and hold arrangement. Now here's the tricky part. Under both IFRS 15 and ASPE 3400, revenue isn't just about sending an invoice. We need to check if the performance criteria have actually been met. So what does that mean? Do you remember the video revenue under ASPE 3400? If not, then check it out in the link above. But now let's do a quick recap. Under ASPE, revenue is recognized when performance is achieved, revenue can be reliably measured, collection is reasonably assured. In a bill and hold arrangements, we focus heavily on that performance piece. Let's break this down with a checklist. For revenue to be recognized in a bill and hold arrangement, all of the following must usually be satisfied. Evidence of an arrangement exists. There must be a clear agreement with the customer. The product is complete and ready for delivery. You can't recognize revenue if production isn't finished. The goods are set aside and clearly identified as belonging to the customer. Think of it like a reserved sign. The delivery schedule is reasonable. It can't be indefinite. The seller cannot use the goods for any other purpose. They are the customer's now. For example, a furniture manufacturer finishes making a custom order for a hotel. The hotel says, "Please hold the furniture until our renovations are done next month." If the goods are complete, tagged for that hotel, and can't be redirected to anyone else, revenue may be recognized, even though delivery hasn't happened yet. Even if all those criteria are met, other factors can impact recognition, like customer's request. If it's the customer asking for the delay, that supports recognition. Risks of ownership. If the risks, like damage or loss, have shifted to the buyer, that's another positive sign. Pricing certainty. The seller's price must be fixed or determinable. If the price could still change significantly, recognition isn't appropriate. This is where professional judgment comes in. Always think about whether the seller has truly fulfilled their side of the deal. Now let's shift gears to our second big topic: principal versus agent. This one's all about who is actually controlling the goods or services before they are transferred to the customer. A principal is the one providing the goods or services. They recognize gross revenue. An agent is more like a middleman who arranges the sale. They only recognize net revenue, which is their commission or fee. For example, think of an online travel agency. If the agency simply connects you with an airline ticket and collects a service fee, it's acting as an agent. But if it buys the tickets in bulk and resells them to you, it's acting as a principal. Here are the key indicators to look for. Control. Does the company control the goods or services before transfer? Inventory risk. Does the company bear the risk of loss if items don't sell? Pricing discretion. Can the company set its own prices? Responsibility. Is the company responsible for fulfilling the contract? Credit risk. Are you exposed to customer credit risk? The more of these boxes you check, the more likely the company is acting as a principal. You might be wondering, why do we care so much? Well, revenue recognition affects everything, from financial statements to investor decisions to tax implications. Recognizing revenue too early or classifying as a principal when you're really an agent can lead to misstated financials and compliance issues. Plus, on CPA exams, these are common topics that test your ability to apply judgment and link facts to accounting standards. Let's wrap it up with a quick recap. Bill and hold arrangements require performance to be achieved, reliable measurement, and reasonable assurance of collection. The goods must be complete, identified, and delivery reasonably scheduled. Principal versus agent depends on control, risks, pricing discretion, and responsibility. Principals report gross revenue, agents report net. If you understand these two areas, you're already ahead of many accountants who find revenue recognition confusing. Thanks so much for watching today's video. I hope this breakdown made bill and hold arrangements and principal agent considerations much clearer for you. If you found this helpful, don't forget to like this video, subscribe to the channel, and drop a comment below with your questions or examples you've come across in practice. I'd love to hear from you. See you in the next video.